All right. Well, welcome everybody to Enhancing the Accountant Bookkeeper Connection series featuring KATA Accounting. This is going to be the last one of 2018. I have already sent out invitations, so if anybody hasn't received an invitation, just maybe put a little note in chat and I can make sure that you're added to the list. But we sent out the invitation to register for the 2019 series, and that is going to be using Zoom and it'll be automated. So there will be reminders that go out the day before and then an hour before the call as well. And you'll we'll still be recording the call. But the good news is that we are going to be applying for continuing education credits and it'll be an hour in length. So if we do get approval for the continuing education credits through IPBC, then what's going to happen is you will need to remain on the call and there will be poll questions that we will ask throughout the call. And only people that are attending live will receive the continuing education credits, but everybody will still receive the recording to follow up with afterwards. Okay, so this is again hosted by myself. I am Tanya Hills. I am a certified professional bookkeeper and the founder of Cloud Bookkeeping Services and Tanya's Bookkeepers Bootcamp. A little bit about me. Professionally, I am the Intuit Global Firm of the Future for 2018, as well as a Canadian runner-up last year for 2017, a 2018 Inspire Award winner, and a top 21 influencer in the Canadian bookkeeping world for 2018. I was voted by my peers to be one of the Insightful Accountant Top 100 ProAdvisors for 2018, a HubDoc Top 50 Cloud Accounting Firm for 2017, a Black Swan alumni mentoring under Ron Baker. I am a Futurepreneur Canada volunteer mentor. I am a member of the Intuit Trainer Writer Network, an Intuit All-Star on the QuickBooks community, which just simply means I answer lots of questions on the community. We are a Platinum ProAdvisor firm, I guess elite under the new tiers, which are just recently launched. Advanced Certified QBO ProAdvisor, Certified QB Desktop, certified in many apps such as HubDoc, WayPay, T-Sheets Pro, certified professional bookkeeper through the IPBC with over 20 years bookkeeping and income tax experience. And I think I need to shave some of that off because that's a lot to say. A little bit about me personally, for those of you who haven't creeped me on Facebook or seen any of my webinars, but I think we've all been here before. I love my family, unique experiences. So my daughter and I go out and we spend weekends with the cast of some of our favorite TV shows and meet some of our bands. And of course, there's a picture of us cruising together. And there's my little Rosie, who is also our office manager in the bottom right. And my daughter and I are learning American Sign Language together. So that's all there is about me, and then just a little brief introduction for KATA Accounting. So I've been collaborating with Jonathan and Bob for a number of years now. We've got multiple mutual clients. They do work in QBO, which is amazing. The collaboration, using an account that works in QBO is just, it's great. And the communication that we have, it definitely makes for a better experience for myself, better experience for the client, because in the end game, it's all about the client's experience. They've got great attention to detail, outstanding customer service, and because of my collaborating and working with them, they have actually made me much better at my job as well. So I just can't say enough good about them. So I guess we can take it away. Jonathan and Bob, you guys can take over screen sharing and do your part.
Thanks very much, Tanya. Okay, I'm just going to set up the screen share right now.
Okay.
Everybody should be able to see the title screen now?
Not yet, no. Oh, it's starting to receive.
Loading.
Perfect. Yep, we can see it now.
Okay. So I'm Jonathan Carter, founder of KATA Accounting. I can be reached if you want to tweet at me at jcartercpa, or if you want to reach out directly by email from this seminar. You might want to reach out to us for some of the information. So that's contact@kataaccounting.com, and somebody will get back to you with either the question answered or reach out to you by phone or whatever it is that you might reach out to us for. And we'll cover those more when we get to those areas. So I am considered to be a thought leader in accounting and technology. I was very fortunate to be a member of the inaugural Intuit Accountants Council I'm a lead ProAdvisor and Intuit All-Star as well, and was very, very grateful to have won the Inspire Accountant Award this year. I am a known collaborator with desires to see improvement. We do work extremely collaboratively. Our first and foremost principle is communication, because that's where we find the most common breakdowns in the bookkeeper client accountant relationship is with communication. I have a lot of experience in the mortgage industry and with rental properties. And as a firm, we're working a lot with e-commerce and digital and affiliate marketing and those other types of internet-based businesses, maybe software developers, app developers, consultants who are only online, things like that. I am a member of the Japanese Canadian Cultural Center's board. I was brought in for my QuickBooks expertise and to help transition from an older, more cumbersome package to one that could provide better information. And QuickBooks Desktop was actually what we moved them to, and hopefully I'll push them to the cloud eventually. I'm also an avid fisherman and MTG and poker player. Bob, tell us about you.
Yes, good morning, everyone. It's a pleasure to be here with you. I'll go through my overview pretty quickly. Went to school for my basic training, but I took mathematics and then shifted over into the accounting world, where I worked for one of the big four CPA firms. Moved into company roles with different, mostly major public companies, where I did development of complex planning models and had some other interesting experiences. And then I hung out my own shingle and did independent consulting with a few companies which are listed there. I was recently awarded a Lifetime CPA Award, which I was very proud to receive. And I've added one item to my list of hobbies. I actually have been doing some car maintenance recently, and I changed out, which is a really new thing for me. I changed out the water pump and thermostat and fan clutch on my 19-year-old BMW, and I'm happy to report I took it out for a drive last night and it worked like a charm. No more overheating. So I thought I'd draw your attention to that. Always like learning new things.
So this session is going to be an overview of the sessions we did from the year. Just kind of a reminder of some of the key areas to think about now that we're coming into the year-end cycle. A lot of December 31st year-ends. What are some of the key things that you have to think about? So at the end, we've talked about this every presentation, is period 13. That period where you put the polish on it. You go over the records and you make sure that you don't have double entered expenses or hanging checks or bad debt that needs to be written off or interest that hasn't been recognized. We'll get into those in more detail as we go. But really what it comes down to is this information that you as bookkeepers are reporting to us as accountants is going to be used by third parties, perhaps in decision making, especially around lending and investing. So it's very important to have good records. And if your clients are giving you pushback on them, ask if any of these things would ever be important to them. It needs to be handled. It needs to be dealt with. So, Bob, you want to start us off?
Sure. We KATA have developed a checklist of things of issues that accountants might look at. So if you're dealing or collaborating with an accountant, this checklist can serve to shortcut questions or deal with them before the accountant even asks. Things like for accounts receivable, you might want to ask about allowance for bad debts. uncollectible accounts, and so on, and update the allowance for doubtful accounts account. And that checklist we do make freely available to any bookkeeper who's interested in it. So contact us if you would like a copy, and we'll.
Oh, Bob just disappeared for a second there. Yeah, please contact us if you'd like a copy. We'd be happy to send that out. Just to give a quick qualification of this checklist, it doesn't cover everything that we need to know about. The actual checklist from CPA is extraordinarily long and very accountanese. So we've created a checklist that's easier to understand and gets to the heart of the matter. Makes it easier for people to complete. So Bob, are you back? Oh, okay. Don't know what's going on. It looks like he got booted from the presentation. So hopefully Bob will come back, but I'll continue in the meantime. So accounts receivable. This is the first one that we always look at. First of all, if it's negative, it really needs to be vetted. If you owe customers money, we really need to make sure that that's correct. When you're looking over anything outstanding, is it collectible? Is it supported? Has it been invoiced? Are there contracts? Things like that. Is it in the correct period? Is the invoice for work that is coming up in the following fiscal year, or is it, and you're just trying to get it in before December 31st, or is this for work, is there work that needs to be invoiced in 2018 that you just haven't invoiced yet? So those are things to think about. You always want the revenue and expenses in the same period wherever possible. Is there any dispute about the accounts receivable, and how fast are things being collected? Usually what we find is there is a degree of cleanup required. It could be allocating to bad debt. It could be booking invoices that represent work being done in this period, things like that. I see there's some chats going on. I'm just going to have a quick look for questions. Okay.
No, yeah, I'll keep an eye on the chat. I'm just
okay.
And I'm creating a separate list already for the email addresses. I'll email you separately.
All right, sounds good. That
Yeah,
would be great. Thank you very much.
I got your back.
You always do. You always do. All right. So moving on to the next one, bad debt. This is definitely related to accounts receivable, and there's a difference between the allowance for bad debt and true bad debt. So you can book an allowance for bad debt if you suspect that something's going to be uncollectible. Get that expense in the current year, and even if the debt is not finally written off until the following year, that's a possibility using the allowance for bad debt account. One issue that we see quite frequently is slow collections or non-collection. And it's very important to identify collection issues early, because there are customers, there are people out there who will take the business and never pay. And that happens, and that's a risk that all businesses face. But these are some of the things that should be considered when you're looking at that. Oh. Inventory, all of our favorites. Now, just a few pieces of information from the CRA. I would always prefer to have a year-end count to be trued up to for the inventory for whatever the business is. But it doesn't necessarily have to be done at year-end, so long as it's a reliable system. If it's not reliable, then yes, you definitely need a year-end count. But if things are flowing smoothly, as long as that physical count is done during the year at some point, it's generally accepted. It has to be, okay, I'm not going to go into the details of this, but essentially, you can't show yourself as having $1 million of inventory if you only have, 200,000 of inventory. These things need to be reviewed. This is one of the key areas where investors will look in an inventory-heavy business is how much have you invested in your inventory.
We do have Dominique asked with regards to expense accounts. So would you create two, one bad debt and one allowance for bad debt. Now, if I'm correct on this, let me see if I've got this answer right. Jonathan, you can correct me on that. The bad debt is an expense account. The allowance for bad debt would be an asset account, would it not?
Yes, the allowance for bad
The
debt
current asset.
is a contra asset to accounts receivable. So this means it's an asset
Yes.
that's normally in credit balance. For example, accumulated amortization is another contra account that we see far more regularly.
Yep.
So what you can do is you create an allowance for the bad debt, so it's a credit to bad debt, and a debit in bad debt expense. And then when you've determined that, yes, this is definitely not collectible, you credit your AR and debit your allowance. So
Right.
that would allow you to, say, for instance, declare that bad debt in 2018 because you're highly suspect that you will not be able to collect it. But the AR sits on your books. You can continue to try and collect it until you've determined that, yeah, there's no way we're getting this. It needs to be written off completely. Now, let's say you've done that transaction already, the debit to bad debt expense and credit to allowance. Well, if you do collect the debt, you essentially do the opposite transaction when you collect it. Happy to go in more detail on that another time or later at the end.
Now, okay, I was going to say, just let me ask quickly to add
Yep.
on to that, because I have had myself, I don't write off much, but I have twice written off smaller ones and sent them to collections. And so when I've written them off, I've done that, closed everything out. And then when everything's come back in collections, all I've done is I've basically gone back in and done it as basically a new sale, because I've already closed off everything, written it off. So therefore, when we're looking to make it QBO happy, again, and whatnot, I've just gone in and I've just created like a new sales item, or a new product, like a new item, to say that, collectible debt, whatever, with a little description, and basically either just go in and just add a sales receipt, or even just when I do a deposit and account that towards a sale. Would that be would that be a good way of handling it as well?
It does effectively do the same thing. I prefer to have that invoice stay in accounts receivable, the original invoice stay there, to track things like statute of limitations, things like that. And then when you collect it, you're just receiving a payment on the invoice. That's just my preference. Your method works. There are some questions about the matching principle because you're declaring revenue in a period where it wasn't earned. But if it's going against your bad debt expense, then you're not actually.
Well, and that's exactly, because because these ones, like, by the time I sent them over and started getting money, we're talking a year and a half later. And at that point, again, to close in QBO, to close the invoice out, I had to put the credit, which applied it to bad debt. Because again, we shouldn't be doing journal entries in QBO. So I did a credit memo, applied it to bad debt, closed off the invoice with that to get it out of my AR list.
Yep, we can do that.
In which case, again, and that was kind of my workaround to be able to work with QBO.
Yeah, that's. I mean, I don't see anything technically incorrect about that, but it's just different ways of achieving the same thing. That's one thing I really like about QBO, is that you can do things in so many different ways.
Perfect. And that's, when I send it off to collections, I don't expect to get anything from it. So anything that does come in, like, again, if it comes in, a year, 2 years later, it's just a bonus to me. So, okay. So that's great.
All right. So skipping back ahead to inventory, the two acceptable methods of tracking inventory are fair market value of the inventory, or the value of the individual items on the first in, first out basis at the lower of cost or fair market value. Now, this is an interesting, just a quick little thing here. I did work early in my career for an organization where the fair market value of the inventory was actually recalculated daily. It was a very unusual situation, but essentially the inventory was raw gold, silver, platinum, and palladium. And of course, in the markets, those values change every day. So a big portion of what this company did was hedging and buying and selling these products on the market, and yet retaining them in inventory so that they could be used in the manufacturing process and bought back from the market as needed. It was a very interesting thing, but not very common. The most common everybody's going to encounter is FIFO, and that's what we like to see. I'm just going to start flying through this because we're already at 10:25. So fixed assets. There's a lot to talk about here. So first definition of a fixed asset: something that provides value over more than one reporting period. So for instance, a car. Car is a great example of a fixed asset. The first thing that we always check for is who actually owns the car. Because the number of times we've seen a car listed on a corporation's balance sheet and the car is not owned by the corporation is really rather astounding. So that's part of the issue. It can create some shareholder loan issues, issues around compensating the owner for the use of a personal vehicle, all kinds of things. I'm not going to go too much into accounting for fixed assets and depreciation. I'm just going to tell you what we do. So from an accounting perspective, anything over $500 is examined. And for larger corporations, over $2 million in revenue, anything over $1,000. But generally, we always do the 500 and then consider whether it's a fixed asset or an expense. Depreciation, we always book the amount that correlates to Schedule 8 in the tax return. That is the CCA rates prescribed by CRA. And that's just to prevent the creation of something called a future income tax account, which can add a lot of complexity and cost to future tax returns. In some instances, you have to be very careful. So for instance, if you purchase a property, it's best to split out the land versus building. If you can't, you can depreciate at 4%. But if you can, land doesn't depreciate, but the building can be depreciated at 6%. So quite often this can result in a larger tax deduction for the client if the land and building are separated. And in any situation, I would always strive for this. There have been situations where it's too late and it's the end of the year. You can get a letter of opinion sometimes from a realtor if you have one in your network, things like that. You should always have a fixed asset register that outlines your fixed assets, where they are, who's in control of them, and then of course we're going to also show things such as amortization on there and amortization schedules or depreciation schedules, and any kind of key information about that. You should also take stock of the fixed assets on a regular basis. I mean, once a year is sufficient, just to make sure that they are there, nothing walked away, and that the fixed assets are in good repair. Like, you don't want to have, desks and chairs that are falling apart still listed as assets if they're just going to be tossed out or they're not safe to use, things like that. And then the accounting for disposals. So when you're doing a disposal, unfortunately, I don't have a mathematical representation here. You need to remove the full cost of the fixed asset, the amount of amortization that's being allocated to that asset. That gives you the net book value. The difference between the net book value and the amount received can create a gain or loss on disposal. This I've seen more and more, especially working with these younger entrepreneurial companies who are kind of funny. They seem to be like all of their staff get like a MacBook or an AirBook or whatever it is, and when they leave, they get to take it with them as part of their thing. I could talk with them about that, but they want to do that. It's their business. They have the money. They can do it. So there's a lot of different complications and issues that can arise from fixed assets, especially if you get into resource-based industries, farming, fishing, mining, things like that. I'm not going to go into detail about any of them because they're all over the place and very specific. I did see that there was a question here. Dominique asked, was there a good reference for the full list of asset categories? She recommends Walter Kluwer preparing your income tax return. And how do you track up the fixed asset register? Right now I use Excel and run a continuity reckon. You know what? We do something very similar, Dominique. We do it in sheets so that we can be very collaborative in the way we're looking at it together. But we do pretty much the same thing. As far as the list that we use, I always go back to the source whenever I can. So I tend to just go to the CRA website and look there. But there's some interesting premises about what can be created, especially when you get into the software development area. And then there's the whole shred credit thing that can come from software development. I'm not going to get into it because we could talk about it forever. So let's talk about a few select long-term liabilities. Well, first of all, are there any more questions about fixed assets or inventory? So there's a question. I run into some difficulties in valuing the building versus land for rental properties due to low sales in older areas. What do you suggest? I'm not sure what you mean by low sales in older areas. What we have done in the past, especially when we have to go back, hopefully it's within the same period. If it's not within the same period, we just usually say too bad, so sad. But we go to a local realtor, one that is preferably very well thought of, and we ask, I'm going to come back to your other things. We ask for a letter of opinion. I don't understand what you mean by no land for sale. So the person is buying the building only?
Hi, Jonathan. I think I'm back. I've been getting kicked out back and forth. But I think they mean no raw land has been sold in that area or region. So it's hard to get a sense of the value of land.
Linda, just to sorry, Bob. Yeah, okay. So that would be where the letter of opinion would come in.
Right.
Yeah. I hope we've answered that, Dominique. Okay, good. I'm going to move on. Nice to have you back, Bob. You want to take over for the long-term liabilities? Linda, I don't believe we have. Oh, we do have a loan. We have the loan amortization schedule. That's not an amortization schedule for fixed assets, but yes, we can make sure that gets sent to you. Bob, I've been hogging the airtime, so I'm going to let you take it away for a little while.
That's fine. Yeah, I've been having my own little adventure here, logging in and going back out. So it's nice to be back. We did a session on long-term liabilities, and this slide is from that session. It indicates common examples of long-term liabilities you might run into or that are possible. Some of these are for larger companies. So when we did the session, we tend to focus on the three mentioned. Long-term loans, and that's where your amortization schedule will come into play. Because as the loan is amortized down, the interest portion decreases and the principal amount being repaid will increase. So that's if you have a fixed repayment schedule. So in some cases, our clients, we ask them for an amortization schedule, which quite often the lender, a bank or a lender will provide. And the reaction from our clients was, amortization schedule? What amortization schedule? So we developed one that's kind of rough. We developed it on our own. And we can make that available to anyone who's interested in it. It may not be totally precise, but it's materially correct. One of an accountant's favorite words, materiality. So we're happy to provide that to people if you could use it. We talked about capital leases. And I'm not going to, again, we're going to say this a lot during this presentation. I'm not going to get into that. Capital leases was developed from a tax point of view to prevent people from kind of maybe cheating a little bit on how they did their accounting. And I'll refer you back to the presentation that we did at that time, which if you don't have these presentations, you can let us know and we can shoot them off to you. And then we had some other things that may not be too common: pension, post-retirement care, and deferred compensation. But we talked in some depth about deferred revenues as long-term liabilities. And just a reminder, by long-term, we meant that they're not expected to be settled within 1 year. And the current portion of any long-term liability is pulled out and shown as a current liability in the financial statements.
Tanya, did you have something you wanted to say?
Yeah, sorry. What I was just going to say is because rather than collecting the names of people who want these, anybody who's not on the call that's getting a recording might end up missing out or contacting us later. So if you guys just want to email me off, and I just sent you an email, what I'll do is I'll attach the amortization schedule and the checklist automatically to the email that'll go out tomorrow with the recording.
Great idea.
Whether it goes out tomorrow or Friday. And then Linda's offering that she's got a fixed asset amortization template as well. So Linda, if you wanted to send that to me, I can go ahead and attach that as well to send it to everybody if you'd like. And that's very generous. Thank you.
That's
And
great.
that was it.
This is what we mean by collaboration, folks. Good for you.
Yeah.
Thank you, Linda.
Everybody gets better together.
Yes.
We absolutely do.
So, Bob, did I move too fast to the next slide on you, or are you?
One of our favorites, accounting for income taxes. This is an area. I don't know. Maybe one of the most complex areas for an accountant, bookkeeper, anyone dealing with a set of books and income taxes to deal with. And the reason is that you're dealing usually with information that is coming from several sources. So you've got bookkeeping entries that are done on the books, either by the client or the bookkeeper. You've got things that Canada Revenue is doing with your income tax account. We have seen if a client has income tax outstanding, but they've got a credit in their HST account with CRA, CRA will grab the money from the HST account to pay off the balance on the income taxes. And as far as I know, the client isn't notified of that. So the client goes on merrily paying their HST, not realizing that CRA has taken some money, scooped some money out of the HST account, so they're underpaying their HST. So things get all mixed up. So you really have to check what CRA has done as well. You also have the tax provision calculation, which is based on the current income for the period. On this chart, I think we're missing a box in the bottom left where that arrow goes to the left. Yes, there's the tax liability on the balance sheet and the tax provision on the P&L. So I just wanted to make clear a lot of entries we see are made into the P&L account. Like the client is paying something. It could be an installment for the current year, could be a balance owing from a previous year, and the entry will be made to the P&L account. That is something an accountant really doesn't like. The tax provision on the P&L, if you think of it, and you can think of this in terms of the matching principle, you have your net income, which is created from your expenses deducted from your revenues, and then you have a tax provision. That tax provision should relate strictly to the net income from the period. So if the client is paying something from a previous year or even an installment from the current year, the amount of that installment payment is not going to line up with the net income. So we should keep that tax provision account on the P&L clean. You look at the net income, you calculate how much income tax is owing on that net income, and you're going to have to do some calculations like adding back depreciation on the books, deducting capital cost allowance, and so on. But the tax provision should be clean and related only to the net income. Everything else goes into the tax liability account on the balance sheet, and that's where you balance everything out, the payments, you book the credit side of the tax provision to the tax liability account, and it all nets out to the net liability that the client owes to CRA. So please, please, if there are payments or any other adjustments you're doing, stick them in the balance sheet account. The other thing we see is that because there can be 3 accounts relating to CRA: payroll account, HST account, and the income tax account. Please try to make sure that you understand when you have a transaction with CRA, which of those 3 accounts are being impacted, and put the entries in the right place. So don't put HST entries in income tax liability account. We see that a lot, and it forces us to go back and look for documentation, and that should all be done in advance. So you have to be a little careful about that.
I'd like to jump in for a quick minute, if I can.
Yep.
Dominique had a great comment that she tracks each CRA account separately on the books. I agree 100%. And there are situations where, say, for instance, somebody has 2 HST accounts or 2 corporate tax accounts, or maybe there's an RZ account. When you're making those payments to CRA, please make sure that you denote which account you're paying to. CRA makes mistakes with the application of payments all the time. All the time happens on a regular basis. So by having it on there, at least you know what it was intended for. And if you have level 2 authorization, you can instruct CRA on where those payments should be applied when you're reviewing the accounts in the CRA portal. I just wanted to emphasize that I really like the idea of the separate account for each item, for each account number on the chart of accounts. So that would be very helpful. And yes, Suzanne says arrears, interest, and penalty. Yes, no, you're not correct. You do need a separate account. Interest and penalties paid to CRA are not tax deductible, and neither are parking tickets. Those are non-deductible expenses that we often see people trying to sneak in. And, if CRA figures it out, you're just creating your client future headache. So I definitely agree, a separate account on the P&L. Exactly, Linda. An undeductible interest or non-deductible expenses is what we usually use. And then one related, one for
I personally usually set that up as an other expense, so that way it doesn't get mixed in with the expenses. It's right down at the bottom on the P&L. So
yeah, the accountant really wants to be able to pick that one out. And I should have made clear that box on the lower right, the tax provision. I was talking strictly about the income tax provision, not about interest and penalties. It's okay to have a separate P&L account and put the interest and penalties in that account. But for the income tax amount owing on net income, that's what I was referring to.
So I just wanted to add one more final thing, just quickly about deadlines. I'm sure everybody knows, but it can't hurt to reiterate. The final tax payment and complete tax payments are due 2 months after year end. Now, most businesses that we work with, it's 3 months because they qualify as a small business. And then the filing is due 6 months after the year end. And then the year end doesn't necessarily have to be December 31st. It could be weird dates. For instance, we've got one coming up who has a January 2nd year end. But, you can't control what's already been done, unfortunately. But I just want to make sure those deadlines were there. So we got pretty active chat going today. That's very nice to see. So moving on. There we are. So, Bob, I'll let you please continue.
Yes, we talked about this in our income tax presentation because it is so complicated, and like in income taxes, your client might have 2 or 3 or more years that are still open and they don't have a final notice of assessment from CRA. So now, in addition to the complications I talked before, where entries are coming from different sources, for income taxes, you've got different time periods to deal with potentially. And you need to stick every transaction in the proper year that it applies to. And when we did the presentation, I went through a quick example. But so just wanted to quickly go through the steps. So step 1 is to look at the client's books and see what they've booked in the period. Then step 2, you go to CRA and check their records to see if independently they have moved money around or if they've applied something in the wrong place. So you're trying to make the client's books match up and be consistent with CRA records, as in step 3. Step 4, you make any necessary adjusting entries. So if CRA has taken money from the HST account and applied it to the income tax account, you'll want to make an entry to reflect that, to credit the HST balance and debit the income tax balance. And then the final step is to calculate the actual amount of income tax owing on the current period's income and book that on the P&L into the nice, clean tax provision account, and also a credit on the balance sheet to show that that additional amount is now owing. So 5 easy steps, but boy, it can take a lot of time going through it.
And just to let's make it a little bit more complicated. If your client is paying installments and they've had a bad year, sometimes they've actually paid more tax up front than what they owe. So it is possible that you end up with an income tax recoverable account in addition to having an income tax provision on the P&L if the client has been paying on a regular basis. So, all transactions. So this is just a couple quick notes. I think Bob has covered most of this, and Dominique with her chiming on the chat was definitely very helpful for this. Yeah, definitely important to have multiple accounts and correct accounts. So now that everybody's glazed over from the tax discussion, we'll move on to something even more exciting: the shareholder equity. So yeah. Shareholder equity is the investment that ownership has in the business. There's several different possibilities. You could have different classes of common shares, preferred shares. There could be an additional paid-up capital component. This area can get rather complicated. Bob, did you want to go into detail on any of the components? We are getting low on time. I think we kind of need to speed things up a bit.
On time. We're in a deficit.
Yeah.
We're in a deficit on time.
Yeah, we're in a deficit on time.
But the one thing I might say about shareholder equity is I think I'm correct in stating that any transaction that goes into shareholders equity, you would normally expect to see the directors having a director's resolution to approve it, like the issuance of shares, the issuance of dividends. You'll usually want to see some additional high-level documentation on that. If there's just money flowing back and forth, in and out, the business is paying some personal expenses, we would usually include that as a shareholder loan. So if at year end you want to record a dividend, technically, to take up some of those monies, technically you should have a director's resolution in the minute book of the corporation. So,
you know what? I need to pile on that minute book topic as well. We've encountered a lot of businesses that do not have a minute book.
yeah,
Minute book is very important. That is where, if this ever ends up in tax court, that's going to be one of the most important documents there are. There are issues around backdating it, so it should be kept as up to date as possible. There are actually some rules about backdating and when you can backdate and how far you can backdate items. It's not indefinite, and it's definitely very important to have that minute book. If your client doesn't have it, you can coach them along with that. We have a template that we use, and there's many other things available online where you can find and see some samples of minute books and so on. These are especially important when it comes to boards and governance for not-for-profits. So I wanted to also throw in a couple things about why to incorporate and when to incorporate. So the when is really, it's a blended question dealing with your personal tax, or the owner's personal tax, as well as the corporation's tax. So if there's a tax benefit to sheltering some income within the corporation and taking it out in the future, that's when you need to start incorporating. When the owner doesn't want to declare all of the revenue as the business as their personal income. There's also some additional liability shielding that comes from incorporation. Very important to note that trust accounts, such as payroll source deductions, HST, those are not shielded by any kind of corporate liability. As a director of the corporation, you're expected and liable for those trust accounts. I had one more thing I wanted to say about that, and it has slipped my mind. Oh, yes. There's been a common misconception that we've encountered quite a few times lately, that you can incorporate a business and then report a whole bunch of information, several periods, when you finally have something to declare, when you finally have income to declare. The rule is 365 days plus 7 days, so 372 days. So we've seen a lot of corporations where they come in and they've incorporated 375 days, or is what they want to report, things like that. Or they've come to us, it's like, okay, I have 4 years worth of information, but I didn't make money until this year, so now I want to do my taxes. Well, I hate to break it to you, that's several tax returns, that's not one. So building these expectations and these habits early are very helpful to keep costs under control and to keep your client out of hot water.
And Jonathan, Suzanne's just asking to get a copy of the template, and I would love that too, because of course I'm incorporating, which the minute book, I think I see there. And then just kind of to put things into a little bit of a more layman term, the way I explain to clients and when I determined to incorporate, because I'm incorporating, I think December 22nd or 7th was, I said, we think the date to start actually operating under the incorporation. And the way I explain it to clients in a way that they can understand is, of course, because we all know, and if we don't know, we should know, that when we're pulling money out on a regular basis, that is what we need to live. If you are pulling money out, I would say once a quarter or less of large chunks, that's something that could be looked at as a dividend, because that's generally when dividends are paid out on a quarterly basis on the stock market. So that's easily tied into that. So basically, I explain to clients, if you need to pull money out every month to be able to pay your bills, there's no point, because that's going to be T4'd. You're going to be taxed at the regular, unless you're looking at liability issues. So that's what I did. I said, okay, as soon as I don't need to pull everything out and I can leave everything in there and either pay myself in, quarterly bonuses or leave it to carry forward, that was the time to do so.
Those
for myself.
Good considerations, yeah. Good considerations. Yeah. So moving on, revenues. Bob, I'm going to let you continue on with the revenues, if that's okay.
Okay, revenues. This is, we normally think of revenues as very straightforward, very simple. You're selling something or you're providing a service, very simple. But revenue accounting can become very complex. And we're not going to talk about that. But in the presentation that we did on revenues, we went into some examples of how complex it can get, and we used the explanation of how Bombardier records its revenues and its accounting policy on revenues. So I think in most of the cases we're talking about here, revenues will be pretty simple. If you want more information on revenues, you can go to that presentation and watch it for half an hour and see some of the details.
Yeah. The only area where people will commonly encounter this is in construction and contracting when projects cross periods.
Mm-hmm.
Those are the most common ones, I think.
Yeah.
All right. So expenses. Now, different accountants operate in different ways. When we're hired to do a tax return, our legal requirements are very, 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 very small. We just can take the numbers, put them in the tax return, make sure they're reasonable, and fire it off. We tend to do a lot more detailed work at KATA. We want to look at, and we want to be able to provide further insights. So we try to balance doing a lot of analysis with doing too much, and just getting too much into the weeds on the books, especially if you get these few clients, where they have 140,000 transactions over the year. It's too much. But we do always query certain things. And it's always related to, being correct and reasonable and to ensuring compliance with CRA. So here's some examples. I'm just going to do a couple of these. Meals and entertainment needs to be listed separately. This can only be written off at 50%. There's an HST issue there as well with regards to sales tax and how much you can claim. Legal, we will look at every legal invoice. Certain legal invoices, professional invoices in general, could be accounting as well, are required to be capitalized. These are items having to do around structure. So let's say you pay for incorporation costs. That's something that needs to be capitalized. You pay for them to review a contract. That's an expense. You pay for, I'm just trying to think of, okay, so you're issuing some new shares. That would be a structure item, and that would be capitalized, whereas, dealing with an HR issue could be an expense. These are some very important areas to worry about. Interest.
And Jonathan, sorry, while you're on the legal side, looking at legal invoices can also tell us about deals that the client is involved in that we may have to put in the...
I don't know if we lost Bob again, but yes, it looks like we did lose Bob. Exactly. Looking at the legal helps us understand the state of the business. If there's anything that needs to be disclosed in notes to the financial statements regarding lawsuits, things like that, HR issues, various other topics. But it gives us a lot of insight into the business and sometimes allows us to add extra value. Now, we're getting really low on time, so I'm going to swim through some of these really quick. We've talked a fair bit about auto, so I'm going to pass over that one. Bad debt's another one. Home office is one where I see all the time. If there is a home office component, there really should be a minute written in the minute book about how compensation for those home office expenses is going to work. Are they charged back to the company? Is the owner a contractor where the home office is deductible on the personal side? There's a lot of questions and different ways of structuring things like that. And items where it could create tax complications. Let's say, for instance, the business is paying the owner rent for the home office. That owner has to declare the expense, the rent on their personal and the corresponding expenses related to that. Interest, we talked about non-deductible versus deductible interest. So that's the main thing there. Penalties, kinds of overlaps there. Repairs and maintenance is the main place where we look for fixed assets. Quite often we find that's where they're miscategorized to. And then miscellaneous general expenses, we hate those accounts because we don't know what's in those accounts. The more detailed information you can give us, the better we can advise and protect the client. Bob, I think you're back. Did you have anything to add about any of these? We're way over time now.
No, I apologize for that.
No.
I don't know what's going on, but
Internet hiccups, they happen.
Yeah, I guess the internet doesn't want to hear me talking.
All right. So it's been a great year for us at KATA. We're so grateful to have won the Inspire Award. And really, I mean, it's these kind of things and working with you guys that really that inspires us to keep going. And having won this award, it gives us that indication that we need to do more collaboration, more working with a variety of people. So we're really eager about that. Just a quick call to action. If you are looking for assistance with client requirements, feel free to reach out. The email is contact@kataaccounting.com. That will go to Neri. Neri will send that along to myself, myself and Bob. And of course, if you want to ask specific relationship questions, sometimes we know accountants don't always have the reputation of being friendly and accommodating. So sometimes there might be some specific questions about how to handle a situation, get resolved what you need to get resolved. So
we want to be friendly and accommodating. So
yeah, well, we have to be firm in instances, but yes, I mean, like it's all about, in the end, it's all about the client, and is the client getting the service that they need and are paying for.
And you know what, you guys are great and amazing with that. You guys are the first accountant relationship that I've actually enjoyed dealing with. And like I say, you guys have made me better because of the communication. You're not just demanding certain things. You're letting me know why, you want certain things, which like I've received compliments from other accountants as to, and these are accountants that still referred to me in the first place. So there was obviously still thought I had quality of work, but yeah, definitely better because of the way you guys communicate. So thank you for that.
Well, thank you. One of the challenges I found when we first started the company was there's a lot of accountants who like to operate in a black box. Do this because I'm the accountant and I'm telling you to do it. Well, that's not really a great attitude. And right. It's not very helpful for helping the people understand the why behind what they're doing.
Well, exactly, because and by doing that, I'm sure that you've even the work that you've come from me. Now that I understand other things, I'm like, hey, I can do this. I can do this. So I'm sure that it's less time for you to have to go through the files because I can now anticipate extra questions that you might ask outside of the normal and answer those questions in advance of you ask. So it makes your job your work easier too.
Exactly. There were a few comments that came in here. There's a little context issue up at the top here. 2.5% about meals entertainment. Yeah, that's similar to what we do. 6.5% for Ontario. Sorry, Suzanne, I'm not quite. Oh, you're asking Linda. You're asking Linda this questions? I'm not sure. I'm going to move on.
Yeah, they were comedic. They were going back and forth together. Yeah.
Okay. All right. Karen, in my experience dealing with you already are a friendly accountant. So
I'm going to say, yeah, if it's the Karen I'm thinking of, Karen McLean, yeah, Karen is quite friendly. We just haven't had any professional dealings because you guys are the first on my list, right? So.
Suzanne, to answer your questions about new clients across the country, yes, we do. We actually work, we've done business in 9 countries now because of the cloud base and most of them are Canadian tax issues, and I've had to have a very long discussion with my insurance this year about doing anything that's not Canadian, but pretty much what it comes down to is we can deal with Canadian tax issues anywhere in the world. And that happens, right? Right now I'm helping a client in Kagoshima, Japan, shut down his Canadian corporation so he can open a new one in Hong Kong in the spring. And, those kind of things happen. People get jobs teaching English, move overseas, rent out the family home, and never declare income tax, never file income tax. Things like that happen. But yes, we are working. I'm just trying to think of probably our furthest away client is within Canada's Vancouver for sure. But yeah, we are doing work in several provinces at the moment. Oh,
And
Karen, thank you.
Suzanne, since you're in Vancouver and talking about working across the country, as an accountant at this stage in my career, there's a lot more road behind me than there is in front of me. And when Jonathan and I first talked about me coming in to work with him, I have to admit, I was a little skeptical, but I was really excited about learning the cloud but I kind of wondered about it. But I have to say, after what is it, Jonathan? Over 2 years now, we've been
Been over
working
2 years
together,
now, yeah.
and it has been a wonderful experience. Like, the communication is there. We can meet on different applications, and I really don't feel that it has hampered or I feel the clients are well served. And as an accountant, a professional accountant, I don't believe it has harmed the financial information that we are putting out there. It's every bit as reliable and
Probably
as
more
good
so.
as, well, yeah, maybe because the communication's so easy.
Hmm.
So if you're in Vancouver, give us a call as if you're right next door.
Yep. The probably the most difficult part for me personally with dealing with the multiple time zones has been dealing with Asia, Australia, because like dealing with other foreign jurisdictions where the time difference is just huge. Your meeting is at 5:30 at night for you, but it's actually 7:30 in the morning for them. It can create some interesting dynamics. So sometimes that means you're not working a regular 9 to 5, but I don't think any of us really do. I mean, part of our kind of way of thinking at KATA is everybody's a customer, and that includes all the people who are doing the work. So if they want to work Bob likes to work in the middle of the night for some reason. I don't know. I get messages on Slack at 3 a.m. and things like that. So, but yeah, there's a lot of, do when you can work, kind of practice with us. So I think we've answered all the questions. Tanya, was there anything you wanted to add? Or Bob, was there anything you wanted to add?
I'm good.
No. Yep. No, I'm good.
Well, thanks so much, everybody.
I just was sorry. Just do want to add, just to make sure that everybody, because I said this at the beginning of the call, but we've had a few people add or join in since. If you have not received an email from me to sign up under our new format, because we're changing from Blue Jeans to Zoom, which will have a little bit of a different format, but it's going to doing it as a Zoom webinar. We will actually be able to send reminders automatically out 24 hours before and 1 hour before, which was feedback that I was getting from a lot of people. So we're officially changing over. So if you have not received the invitation to join, sign up for the webinar, please email me and I'll send it over to you. If you do not join up and register for the webinars, you won't be getting into our 2009. So please make sure that you do that. And again, if you didn't receive it, reach out to me and I'll make sure that that you receive it. And that's great.
All right. Look forward to hearing from everybody. Yeah, take care, everybody.
Perfect. Thanks, everybody. Take care.
Bye.
Okay. Bye.
Bye.
Bye. Dominic and Suzanne, I will email you guys right now the webinar link, which has the dates for the whole series on it, and it'll be just sent in once when you register. You should have the option to download immediately. And anybody else, just reach out. Okay, thanks everybody. Take care. Bye.